Welcome to the Kinvestor Report, where I sit down with analysts and industry experts to discuss mining, commodities, and the market. I'm your host, Arlen Hansen. This interview is not investment advice. It is for listening pleasure only, and I will disclose any positions owned by Kin Communications or myself in this interview. Today, I'm joined by Adrian Day, founder and president of Adrian Day Asset Management, where he specializes in global diversification and resource equities, also the portfolio manager of the EuroPacific Fund, and spent many years as a financial investment writer, where he gained quite a large following for his expertise in searching out unusual investment opportunities around the world. Authored 3 books on the subject of global investing, which everyone I think should read, and we'll put information on that at the bottom of our captions. Recognized authority in both global and resource investing, and I'm super pumped to have him on the show today. Adrian, how you doing?
Well, I'm doing very well, and thank you for asking me, Alan.
Awesome. Adrian, I want to talk to you about longevity, because you have it. You've been doing this for more than 50 years. Rick Rule said it online yesterday after you interviewed Jesse. So that means you're not only a survivor, but you are a mentor to many investors out there. What is the key to longevity in the junior resource investing world, do you think?
Whoa, that's a big question. And I guess there's a lot of things. I mean, the first thing, there's a lot of things. The first thing is, if you're dealing in a space like the junior resource, you really have to understand the volatility. That is the most critical thing. You know, a lot of generalist investors will move into gold, and they might buy Barrick and Newmont, the top 2, and you know the stocks go down 10% and they freak out because that's not what you're used to in broad markets. Maybe it is with Nvidia and Tesla, but you know, in most of the stocks, you don't get the S&P go down 10% very often in a day. So I think volatility, understanding the volatility is the most important thing. And I know Rick, you mentioned Rick talks about that. And you know, there is a way, as Rick says, to make volatility your friend, not to be afraid of it. I think the second thing that goes along with that is, you know, to make sure you size your positions properly. A lot of people I know, when the gold market's going up, they sort of go overboard.
All in.
Right. Now, some people might think that, you know, for me, with managed accounts with 35% in gold, I'm already going overboard. But maybe, you know, but I mean, I think it's a matter of not going overboard. Never use margin for juniors. I have people use margin. I mean, just.
That's a really good point. Really good point.
I mean, I had a client once who freaked out and wanted to close his account, and I said, well, yeah, this is not a good time to close. Anyway, it turned out that the guy had taken a home equity loan to invest. So, you know, that obviously you don't do that. I think the other thing is, and this is always, I'm going to say 2 things at the same time that sound contradictory, but one is to have patience. Because as you know, expiration, or even, it doesn't even have to be expiration. It can be anything in this business, takes a long time, and it takes longer than you expect it to. On the other hand, I think it's critical, it's important to cut losses as soon as things start to go wrong. Now, those 2 might sound contradictory, and I think experience will begin, not that, of course, I don't always get it right, but that goes without saying.
What? You're not 100%?
But I said it anyway. But I think experience will begin to teach you when you should be patient and when you need to, you know, just cut losses. Mm-hmm. One of the things I have found very much is, and this sounds obvious, but when you really know a company, and by know, I don't just mean you can quote their latest earnings down to the 5th decimal point, but you know it and you understand the company, you have a much better insight as to what you should do as an investor when the stock actually goes down, or indeed when it goes up, because that's the other part of this. You know, if you're investing in junior gold stocks, I have too many people who it goes up 15% and they just sell. Well, you don't buy junior gold stocks for a 15% return. And so I think the more you know and understand a company, the better positioned you are to know when something goes wrong and the stock goes down, is this a buying opportunity or is it in fact a time just to cut bait? And conversely on the upside. So I think those are some of the most important things.
I like what you just said there. It's like really understanding the DNA of the company, not like the financial statements, not saying, oh, they got XYZ amount of reserves or resources. They're going to drill this out.
Yeah.
Well, yeah. What's the DNA? How's the corporate structure? How's the leadership? How do they manage their employees? Right? How do they create
Absolutely.
accountability with their employees? Are they issuing paper for people that are just getting free rides? That's the DNA we're talking about.
Sure.
Right?
Absolutely.
Yeah. It kind of makes me want to bring up this quote from Benjamin Graham. You know, the longer the bull market lasts, the more severely investors will be affected with amnesia. After 5 years or so, many people no longer believe that bear market is possible. So, Adrian, I'm flipping that around today and saying the longer the bear market, the more severely will be affected by amnesia. And after 5 years, and I pull up this chart of the TSX Venture Board, and it's been 15 years. So never mind 5 years. After 15 years, do investors like have dementia that these stocks can perform again? Like,
Right. No, interesting point. I mean, we know that cycles in the gold and commodity space tend to be long. You know, gold cycles tend to be longer than a normal economic cycle, and commodities generally, the cycles don't really correlate with the economic cycle. It's more a matter of capital investment. If you go for a long period without capital investment, then you have a long period of underperformance. And until you get to that point where you simply don't have sufficient supply, and then you get you potentially have a sharp or a sustained up move, which has little to do with, it doesn't necessarily overlap the economic cycle, is what I'm saying. But yeah, cycles in the gold space tend to be long. And, you know, especially after a period like 2011-12, when, let's face it, the prices did get a little overdone on the upside. No, it does take a long time to wash all of that out.
yeah, it certainly does. So we talk about like the story of gold and why we're buying gold and why we believe in gold. Has the argument really changed over the last 40 years? Or now is just people believing it? And then we're going to go into sentiment after this.
Yeah, I'm not sure that the story has changed. I mean, the central story of gold, to me, is and always has been, you know, for 4,000 years, ever since I can remember, it's been to preserve your purchasing power.
100%.
So this is the central issue, to preserve your purchasing power in the face of declining and evaporating fiat currencies. And of course, a lot of things play into that. What's the value of the dollar? What's the level of interest rates? What's the level of real interest rates? And all of that. But in a way, those are all factors that affect the central issue, which is if fiat currencies are holding their purchasing power and going up, people typically are not going to be wanting or needing gold. That's not the world we live in. And so I think that's the central issue. Now, of course, other things that I mentioned, the value of the dollar, the value of the level of real interest rates.
Yeah.
Everybody knows what that means, right? The level of real interest rates and the outlook for interest rates. Because, of course, markets always look not so much at absolute levels, but at future directions.
Of course.
So if interest rates are 4.75%, but declining, you know, that's obviously a positive for gold, more positive than if they're 2%, but going up. There are other things that can affect gold in the short term, but frankly, things like geopolitical, a lot of people talk about geopolitical risk and geopolitical events, bad events, do tend to support gold. There's no question about that. But they tend to be short-lived.
Yeah, they do.
Yeah. And
Yeah.
so, you can go all the way back to the Iran hostage crisis in 1979, but, you mentioned 9/11 before we got online. You mentioned 9/11 or the invasion of Iraq, or, all of these things tend to be short-lived for gold, and it really depends what else is happening at the same time. And so gold didn't begin a 10-year bull market in 2001 because of 9/11. It began a 10-year bull market because of the monetary factors.
Yes. And that leads perfectly into my next question. So this was a setup, Adrian. I want to talk about sentiment, because if the big macro story really hasn't changed for 40 years, give or take these other events, what's changed about sentiment? Like, I just walked Toronto seeing all the funds and the analysts, and I was just in New York at the mining show, which we'll talk about very quickly too as well. And it felt like there was a massive change in sentiment from even 2 months ago. Do you feel that right now?
There's definitely, I wouldn't use the word massive, but you mean it's changed more bullish?
Yeah, you know what? There's a pulse. Let's put it that way. Yes,
Yeah,
there's a pulse finally.
No, definitely. That's absolutely true. I think we have to step back, if we may, if we're looking at gold. Obviously for the last 2 years, people have been saying, well, gold's going up. Why are the ETFs getting withdrawals? Why aren't the gold stocks going up? So on and so on and so on. And, it really was, when you think about it, it's very simple, but also very logical. The reason gold was going up for the last 2 years, the reason gold was going up for the last 2 weeks until this summer, was because central banks were buying. Number one, they were the largest source of buying, because Chinese consumers were buying, second largest source, because wealthy families primarily in the Middle East and in Asia were buying, third source. And at the same time as those were buying, we had these big outflows, as you know, big outflows from Western, that's Europe and North America, ETFs. And, people are saying, oh, Americans are always the last to, the Asians are so smart, they get on board first, and we're so slow, and all that stuff. But when you think about why those groups I just mentioned were buying, and why the Western investors were selling, it's all logical. The central banks were buying because they're worried about the weaponization of the dollar, and they want to diversify their foreign reserves away from the US dollar. Chinese consumers were buying because they're worried about the slowdown in the Chinese economy, possible devaluation of renminbi. They don't want to put money in the banking system, sensible. Up until recently, they didn't want to put money in the stock market because it was, on a 2-year 40% decline, straight line down. They didn't want to put money in real estate, very sensible. They're not allowed to buy crypto. So the obvious place to put your money for preservation is gold. Now, those factors had absolutely they meant nothing to a US investor. A US retail investor, I'm not worried about the weaponization of the dollar. Well, I am, but it's not, they're not going to come and snatch my reserves anytime soon, I hope. We are more worried about what I call the traditional factors that affect gold, which are the economic factors, which are, as we mentioned, the absolute level of interest rates. And so what you had 2 months ago was you had high interest rates, seemingly low and declining inflation, therefore high real interest rates, a seemingly strong economy, a seemingly strong stock market, and a reasonably strong US dollar. Well, in that environment, the absolute worst investment you can think of is gold and gold stocks. And so it's only when that's begun to change that the environment becomes more attractive to Western investors. And, every time since after the Paul Volcker era, every time the Fed has stopped an interest rate hike cycle, on the first cut, you always see a big move in gold. And that's exactly what we saw, last month. So I think in the last 6 weeks, 2 months, Western investors are beginning to see that we're on a rate cutting cycle. They're beginning to see more clearly that the economy is not as strong as it suggests. We've had some drops in the US stock market. Leaders like Microsoft dropped, Tesla dropped, come back, but it's clearly not the Magnificent Seven are clearly no longer a one-way street, and so gold and gold stocks become more attractive. So yes, I think there's and just to wrap that up, if I may, the interesting thing is probably and most of your listeners know, but even up until the end of September, if you look at the monthly numbers on gold fund flows, the vast majority of funds were continuing to get net outflows all the way through to the end of September. On a monthly basis. Now, they may have stopped in the middle of September. I don't know because they're not reported daily. But there were significant and steady outflows from gold ETFs, but also from gold equity funds. That has definitely changed. But we're still, in my view, we are still very, very, very much at the beginning. I mean, you kind of joked about there's now a pulse. I mean, the gold 1-to-1 was, yes, people were excited, the people that were there, but it was very poorly attended. Funds are still getting, whereas it used to be 4 days of outflows, 1 day of inflows, now it's sort of 3 days of inflows, 1 day of outflows. So it's certainly not what I would call a massive flood of money pouring into gold stocks at the moment. Which is, from a contrarian point of view, positive.
Yeah. So now that we're here and all these people don't believe that gold can ever do well, and now they're starting to see it on the media, right, paying attention to it, what do you want to tell the investor who's just kind of new to this and that they think, oh, gold stocks have already run too far, or I'm looking at these things, right? Like I want to get into the fear and greed of the market. Like Jim Dines was one of my favorite authors too as well, because when it comes back to that question about like what's changed about the story of gold, not much, but our emotions have, our fear and greed's changed. And I just think that like these investors that now have been learned the last 10 years, you can't make money in these stocks. And now they're going to start learning that they can.
Right.
And one thing the gold market has never seen is the power of social media. Like the real power of social media and what they can do when these influencers and these investors start getting hold of these trends. And I think we know how small the gold market is, right? Rick Rule talks about if the world allocation went from 1% to 2%, where gold would be, I don't know what he says, 20,000, 10,000. I don't know. But it just, what do you want to tell that person that like, this is the beginning. This is the beginning.
Well, yeah, so I do have something to tell that person. First of all, I'll ask the question, do you know that gold has actually outperformed the S&P for the last 1 year, 2 years, and 3 years? Do you know that gold has actually outperformed the S&P this century? Most people do not believe that.
I have no idea.
They go look at the numbers. And when I say outperform, I'm talking about including the interest, the dividends that the S&P pays. Do you know that gold stocks have outperformed the S&P for the last 6 months, for the year to date, and for the last 12 months? People are flawed. People do not know that. This has been a stealth rally. So that's the first thing. These things can move. Not only can they move, they have moved, and you need to stop listening to, CNBC and the financial press, but typically doesn't like gold. So that's the first thing. The second thing I'll say is, I think we are just at the beginning of what I would call a normal traditional gold market. What we saw in the last 2 years, as we discussed earlier, were different types of buyers buying for their own idiosyncratic reasons. It was like an hors d'oeuvre, if you want, or since I'm an opera fan, it was just the prelude, the overture.
The opening act.
It was just the overture, and the curtain is now rising. Okay, so if you look at this shows you that gold stocks typically have enormous leverage at the beginning of a bull market. After gold bottoms, in each of these cases, it's the bottom for gold at the beginning of a bull run, or a short-term rally at least, and it's 3 months, 4 months, 12 months, etc. But at the beginning of every single time gold bottoms and moves up, the gold stocks dramatically outperform. And by dramatic, I mean dramatic. Look.
Yeah, that's big.
6%, 82%. I mean, these are astonishing.
Yeah.
Now look at 2024. This was done a few weeks ago. Sorry. So the 2024 numbers are out of date. Let's look at the last 6 months, for example. Gold is up 20%. And the XAU is up 24%. That's the last 6 months.
Mm-hmm.
If we did it year to date, those numbers are actually identical. So we just haven't seen the leverage yet.
Yeah.
And the reason we haven't seen the leverage is because the normal traditional gold market has only just begun. If we go back to middle of September, when the Fed cut rates, the gold stocks have well outperformed gold.
Yeah.
And so that's the first thing I would say to the person who thinks they've missed it. When you look at the numbers on that other chart, the outperformance in 3 months, 6 months, 12 months, 84%, 50%, 122%. We haven't seen that yet. So we got a long way to go. The second thing I would say is that the stocks are just dirt cheap. And by dirt cheap, I'm not talking about the price of the stock. Like Newmont or Barrick is $20, and in 2011 it was 55 or 60 or something. That's for price. And Oscar Wilde reminded us that there's a big difference between price and value. Look at the value of stocks. Agnico Eagle, for example, if we look at the estimates of their earnings, they're going to report next week. Tomorrow, actually. They report tomorrow or tonight. They report. So we'll know tonight. But the analyst estimates for what Agnico is going to be earning will put their price to free cash flow at 7.5 times. That is in the lowest decile of their price to free cash flow in 40 years. Now, typically, when the price of gold moves up, you see multiple expansion, right? Mm-hmm. These multiples get higher. You saw that in 2011 with Agnico. You saw that in 2008 with Agnico. But right now, they are selling in the lowest decile. Look at Barrick.
In 40 years? You said 40 years?
40. So in that entire history. Look at Barrick. Barrick's price to net asset value, again, is in their lowest decile of their 40-year or 50-year history. Now, people look at Barrick and say, oh, but they're in Pakistan, they deserve a discount. True, true, true. But the net asset value is still supposed to take account of the political risk, right?
Yeah, of course. Yeah, yeah.
But let's just, but still, it shouldn't be trading in the lowest decile of its history. And so that's the second thing. These stocks are cheap. And I'm talking about 2 of the 3 biggest.
Yeah.
You further down the food chain and they get even cheaper.
Yeah. Obliterated.
So they're only at the beginning of a bull market. Number 2, stocks always outperform at the beginning. Number 3, the gold stocks are very, very cheap. And then the last thing you mentioned, referring to Rick, Rick always likes to talk about how the ownership of gold and what what it normally is. Bank of America did a survey, unfortunately, a couple of months ago. I'd like to see it updated, but they showed that 80% of advisors had less than 1% allocated to gold in their portfolios. And I am willing to bet that a majority of that 80% had zero. Zero.
Okay, let me hear that. I want you to repeat that. 80%.
Yeah, they did a survey and they showed that it was like 78% of investment advisors had less than 1% allocated to gold assets of any type in their portfolios. And that is very, very unusual. And as I say, I'd be willing to bet that most of those people had nothing. Now, when I came into the business a long time ago, as you very kindly reminded your audience. When I came into the business a long time ago, all the way through to 2010, 11, right? You could look at any mutual fund you wanted to, a US big cap, an emerging market, you know, a value, a global value, whatever you wanted. Look at any mutual fund you wanted. Every single mutual fund would have some allocation to gold. It was just like normal. You have some gold as a foundation, as a defense, as a hedge. Yeah. You look today, other than commodity funds, dedicated gold funds, dedicated commodity funds, you know, I can only think of one fund, the First Eagle Fund, a global fund that has any gold in the portfolio.
I want to make a comment on that too as well. My history with working with investment advisors and brokers, and it's kind of my job, I've learned that brokers and investment advisors tend to only want to show product or show things that they know their clients are going to want to say yes to. Right? So, of course, 70% of brokers have not been calling their clients and saying own gold stocks because it ain't working yet. And their investors don't want to hear about it. But that is what I'm trying to get across to the market right now. When that changes, and their clients are calling their brokers saying, find me as many gold stocks as you can, like that's when this market gets absolutely ridiculous. And it's going to happen.
I don't know if I can show a difference. Oh, I don't have it on this. I'm sorry. So never mind. But yeah, people forget just how small the gold sector is.
Totally.
And the silver stock sector is even smaller, of course. But if you look at the precious metal equities worldwide, including producers and explorers, it's about $600 billion market cap. A lot depends on, do you count, you know, this base metal company that has some gold, et cetera, et cetera. Yeah. But basically, we're talking 600 million. Compare that with Microsoft or Apple, you know, over 3 trillion. It's a tiny, tiny market. Do you know that NVIDIA sometimes, if you look at a 10-minute candlestick chart, it'll sometimes gain or lose
$1 billion.
10 minutes, $250 million. That's, you know, 40% of the entire market cap of gold.
Yeah. Well, hey, didn't China just issue $1 trillion worth of paper to stimulate okay, so yeah, they just basically gave the entire world's gold market cap to the economy of their country. Just like that, just like printing it.
And so when investors return to the gold space, yes, you're going to see the stocks move up simply by virtue of the fact that, you know, there's more people wanting to buy a limited source. Now, you and I both know that when we have a strong market, the boys on Howe Street and the boys on Bay Street will manage to create new companies and issue new equity and so on and so on. But that still won't keep up with the demand.
Yeah, I totally agree with you. So like kind of to me, all roads point to gold and silver right now. And, you know, all my audience here, I'm sure they're commodity lovers, but I always like to be realistic, you know, and I always like to tell everyone who's super bullish, well, what is the bear argument?